guys. In this video clip, I'm going to demonstrate to you the understanding and calculation using capital asset pricing model and the understanding of security market line. Capital asset pricing model is used to assess a fair return for an investment portfolio. And this fair return is based on the systematic risk of the portfolio that is exposed to. So let's look at this. And this is the formula for capital asset pricing model. And we can see how systematic risk is taken into account in this formula. The systematic risk is represented by beta risk. The definition of beta risk is the covariance between the asset or a portfolio and the market portfolio, then divided by the variance of the market portfolio. So variance of the market portfolio is the risk of the market portfolio raise it to the power of 2. So beta risk actually also incorporate the information of how this investment co-move with the market portfolio in regard to the return performance according to different market scenarios. So this co-movement is represented by this covariance. We have learned the covariance in earlier topics. So the formula of capital asset pricing model shows that the expected return of an asset or a portfolio equals the risk-free rate plus beta risk, then times expected return of the portfolio minus the risk-free rate. And we have parentheses for this expected return of the market portfolio minus risk-free rate. And the capital asset pricing model by its means can be analogous to a kind of ruler measuring the fair return of an investment based on the level of systematic risk it is taken. So this kind of ruler have a common unit measure, that's the expected return of the market portfolio minus the risk-free rate. Because we know that market portfolio is a theoretical portfolio and applicable to all investments. So now let's look at examples provided under this topic. First, we look at beta risk. So by its definition, beta equals the covariance between the investment and the market portfolio divided by the variance of the market portfolio. So given the example here, for beta risk under example 1 equals the covariance between asset Y and the market portfolio denoted by M divided by this variance of the market portfolio, and here we use brief, like VAR denote variance, COV denote covariance. So then we can get beta risk for the 3 examples. Then we move on to look into the calculations using capital asset pricing model from examples 4 to 11. So based on the formula here, we know that expected return of the indirect property investment equals the risk-free rate plus beta risk, right? So beta risk is here, beta risk, then times parentheses return of the market portfolio minus risk-free rate in the parentheses. Then we have this, around 9.82% expected return of the indirect property investment. Then we can just move the cursor here and we can get all the answer. So important implication here is we will compare for beta when it is in between 0 to 1. For beta, that is positive less than 1 or negative more than -1. And we will find that when the market portfolio return increase, for example, by 3%, and we will find this investment expect return using CAPM model, the increasing return will be less than 3%. So that means this investment for a beta risk that is positive, less than 1, or negative, larger than -1, and this investment will be less sensitive towards the performance of the market portfolio. On the contrary, for other investments and that they have beta risk larger than 1 or smaller than -1, and we will find that they are more sensitive towards the change of the performance of the market portfolio. So as in examples 8 to 11, and we do see for this beta risk larger than 1 or smaller than -1, when the market portfolio increase return at 3%, and this investment's fair return will increase more than 3%. So beta risk by itself indicates how sensitive this investment is in regard to the systematic risk of the market. So now let's move down to look at the application of CAPM model in regard to this security market line. For the slide here shows the security market line. And actually this security market line represents this capital asset pricing model. And along this security market line shows all fair return based on the different level of systematic risk. And like the horizontal axis shows the beta risk, vertical axis shows the return. The blue line here shows this security market line. That's based on the calculation of the capital asset pricing model. And this security market line divide this beta risk and the return space into two areas. Any investments, if they have estimated return above the security market line, and that shows that these investments are undervalued in the market. The reason is because the estimated return for these investments above the security market line, the estimated return is higher than the fair return based on this capital asset pricing model. So when you have investments that estimated return based on cash flows is higher than fair return, it implies that this investment is undervalued in the market. Also means that you can now buy cheap for this investment in the market, so that can give you a higher return than its fair return. On the contrary, any investments they are below this security market line, they are overvalued. That means the estimated return of this investment is lower than the fair return based on the capital asset pricing model. It implies that in the market, this investment is overpriced. So you have to buy it at a higher price than its fair price, so that this will drive down the estimated return for this investment. So the key application of this capital asset pricing model is to evaluate whether any investments are overvalued or undervalued using the fair value or fair return based on this capital asset pricing model. And the other key application of this capital asset pricing model is about a required rate of return on equity based on the systematic risk. This required rate of return on equity, or we call risk-adjusted return on equity based on systematic risk. And this concept will be utilized later on in the financing part, financing decisions, of a later topic. And the key part we understand from this capital asset pricing model is that this conventional model incorporates systematic risk only. The underlying assumption is that any unsystematic risk will be diversified away in an investor's portfolio based on these investors' discretionary and strategic diversification investment decisions. So overall, for this capital asset pricing model, and we know that it indicates a fair return for an investment based on this systematic risk. Thank you for your watching.